Hey, Dan Passarelli here. Today we're going to talk about a very unique situation. We're going to talk about a strategy called backspreads. Now, I say a unique situation because these are trades that I don't use a whole ton. I use sometimes. And under the right set of circumstances, they can be an extremely practical trade. Overused, they probably won't work out. So let's talk about why you might use it and how to trade them. Let's say you have a stock like Wells Fargo here, for example. Now, this is just a very hypothetical example. They were upgraded and they've really broken out above the 50-day, 20-day moving average, 50-day moving average, and they're really on a tear. It's been up since for the past year, on and off, and really growing in momentum, okay? Now, let's just, for argument's sake, hypothetically say we think that the most likely scenario is that Wells Fargo really takes off a lot. There's a chance it could pull back. I mean, the RSI does show it a little bit overbought here. But, we're making the assumption that the most likely case scenario is that it really takes off to the upside or it has a bit of a pullback. We're going to assume the least likely case scenario is that it just kind of goes up a little bit over the next 3 months, right? And 3 months is our target here. Backspreads are called backspreads because we tend to use further back months or expirations with more time to expiration. So if we go over here to the Analyze tab, we might look at this 3-month option, which in this case is the April monthlies, and look at buying the 52 and a half calls and selling the 52 and a half calls and buying a good handful of the 57 and a half calls. So what we do on the Thinkorswim platform is we go to Analyze by Trade, go /ratio, and this shows us buying the 52 calls, and we're going to assume selling the 57 calls. We're able, if we sell 10 of the 52 and a half calls and buy 20 of the 57 and a half calls, it's almost a scratch. It would be mid-market price of 12 cents. Now, what does this look like? Well, look, here's the scenario. With the stock trading at around 55.80 right here, here's our P&L diagram. And let's kind of bring this in a little bit to show over a 3-month period, a stock like this can really move. And so we want to be able to visualize that. So the worst case scenario is that it rallies right up to the strike price of 57 and a half. But that is the case that we believe in this hypothetical example is the least likely. What we really think is that it could have a lot of room to run, again, in this hypothetical example. And if it busts out to or through where they were just upgraded to, which is $54 by Jefferies, but if we believe that it's really going to far exceed that, once we get through that break even, this trade can become immensely profitable because we're net long one contract for, in this. We're short 10, we're long 20. So ratio-wise, we're net long one, right? If it retraces, gets that pullback because the RSI says it's overbought, that's okay, because all we would lose on that if we get down to a low enough point, which in this case would be 52 and a half. That's the other strike price we're short. All we would lose is what we pay for the spread. So there's pretty much no risk there. We just sort of have this middle risk zone. Now, look, a lot of stocks do just sort of grind higher, and this would not be practical at all for that, at least not the call backspread. But if we're looking for a longer term horizon, we're looking for something that has had a lot of momentum for a while, we think it's going to keep going, and it's particularly on a tear, this can end up being a very, very low cost practical strategy. This is Dan Passarelli, Trade Smart.